Warner Brothers Discovery's Q2 earnings further illustrate the company's declining fundamentals, casting even more doubt on the Paramount deal closing. Meanwhile, Disney Plus's value proposition expands. Listen on.
Hello and welcome to this week's edition of Inside the Stream. This is Will Richmond from Video News, and Colin Dixon from End Screen Media joins me. Colin, you're smiling. Things must be good there.
They are. I'm actually smiling because I tried to do something that Disney says I can integrate my profiles between Hulu and Disney Plus. And I had to resort to the internet to figure out how to do it. So,
when you say the internet, you mean Claude, ChatGPT, Gemini, or some
just
other?
Plain old Google search was enough.
Oh.
But I got it done. But I still would rather use the Hulu app than the Disney Plus app. But I guess anyway, that's probably a subject that we're going to return to in a little bit, because Disney earnings were this week and there were several interesting things that they said. But before we do that, we want a little bit of continuity from last week, right?
Right. We want to give an update here on what's happened in the last week with the Paramount Warner Brothers Discovery acquisition. And there have been a number of things that have happened just in the past week, which shows really just how fluid this situation is. First is, I just want to point of quick clarification. When I went back and looked at I listened to last week's podcast, I incorrectly spoke. I said that Oracle stock was down 70% year to date. It's actually, at that point last week, was down 70% in the past year. The stock has actually rallied a bit, so it's now down year to date 27%, around in the mid 140s. All of this is only relevant to the extent listeners might recall that to the extent that there's downward pressure on Oracle stock because Larry Ellison may have to use more of that stock to potentially fund a greater portion of the equity of Paramount's buyout of Warner Brothers. The stock price matters both to him and also to other shareholders. So I just did want to make that point of clarification, but let's go ahead and move on to what's new in the past week. So first thing that's new is we have a trial date. The judge has decided on an early March 2027 trial date. That leans more to what the states were looking for. States, I think, were looking for like an April trial date start, and Paramount was looking, I think, more for like a January trial date. So a little bit more in the favor of the states. I believe it's a 12-day trial. Important to know, as far as I understand, there's no clear timeline on how long it will take the judge to make a ruling on the case. So I don't know if it happens a week later, a month later, 2 months later. Totally unclear, but as we talked about last week, we need to keep in mind that, again, for every day that goes by that this deal is not closed, Paramount owes $7 million ticking fee to Warner Brothers Discovery, and that can go, if it goes all the way to the outer date of the potential closing in June, that could amount to about $1.7 billion. I think also worth noting that if the judge's ruling goes against Paramount, then, of course, Paramount might choose to appeal the ruling. And when it comes to an appeal timeline, I think all bets truly are off how long that could take. I'm not a lawyer, so I don't know exactly. I guess it goes to the Court of Appeals, and if that goes the wrong way, you could take it to the Supreme Court. Hard to believe that the Ellisons are going to take this deal all the way to the Supreme Court, if the Supreme Court would even hear such a deal, but which they obviously wouldn't. But, well, I shouldn't say obviously, but they'd be unlikely. But in any event, we have the ticking fee, we have a trial, and we want to really return to the main point that we were making last week about Warner Brothers Discovery's inherent value deteriorating as time is going on. We made that assertion last week based on the most recent financial performance. But now we're recording here on Thursday. As of this morning, we have Warner Brothers Q2 performance, financials just reported today. And boy. UGLY. How's that for a word to describe them, Colin? Take it away.
Well, there was one bright spot, but as you say, pretty ugly overall. So revenues for Warner Brothers Discovery in the second quarter were down 11% from 1 year ago. And that is ugly indeed, down $1.1 billion from 1 year ago. And I think it's fair to say that that mostly came from two groups. I'm going to start with the good news. The good news is the streaming segment is actually doing pretty well. So total revenues there are up 10%, and you saw pretty healthy growth in distribution, subscriber-related revenues rather, and advertising, all up pretty substantially. So that's all to the good. That business is now generating about $3 billion, $3.1 billion in the quarter. So it is contributing a substantial amount to Warner Brothers Discovery's overall bottom line. But
before you get to the but, sorry, Colin, I just want to interject for a moment. Before you get to the but, meaning the other two segments, that revenue growth in Q2 of 10%, that's roughly in line with what we've seen from the others who have reported. Netflix, I think Disney, we're going to talk about in a moment. Yep. I think Peacock may have been in line. So they're at par with the rest of the industry, which is certainly good news. One might say that you'd like to see an outperformance if possible, but they're in line. Certainly that's in the scheme of things, that's good news.
Indeed. And one of the things this illustrates, Will, is I think this business would be very additive if it came together with Paramount streaming business. The two of them together, I think, would be clearly stronger in the streaming segment than they are apart. So that's all to the good. The bad news is that the studio segment had a pretty disastrous quarter. Total revenues were down 39% to $2.3 billion from $3.8 billion a year ago. And one of the things that the executives of the company pointed to was just, they had a lousy quarter for movies. They said that Minecraft movie, Sinners, and Final Destination Bloodlines did really, really well in Q2 2025, and that really didn't have anything that did nearly as well in this quarter. So that's one of the reasons why that. And, the studio segment is very variable. So I guess we can forgive them for that. What we can't forgive them for, unfortunately, is that television is not nearly so cyclical, and their television business continues to crater. It was distribution revenues were down 9%, this has been like a steady tick. If you look at many of the TV providers, they're seeing regular declines now of 8, 9, 10% in revenue that they're getting from traditional pay TV. Advertising revenue, though, cratered 27% down from 1 year ago. They pointed to the loss of NBA as being critical to this, but they lost other things as well, like NCAA March Madness, and some NHL also disappeared. So this is an absolute disaster. And you just have to look at the revenue, down nearly $1 billion from the same quarter last year. So this really, as you say, just plays into the question about when all of this bidding war was ignited for Warner Brothers Discovery and they arrived at the valuation. You've got to ask yourself, is this company really worth what it was worth back then? And with numbers like this, it ain't. And if it continues to do this, it's going to be worth quite a lot less by the time that judge finally rules next year.
Yeah, I mean, again, that was the core point that we were trying to make last week, is that this company's fundamentals, the fundamental financial performance continues to decline. And in practice, companies whose fundamentals are declining should be worth less.
Yep.
Now, it doesn't always work out this way. We want to give that caveat. The market works in all kinds of different ways, and it depends on how motivated a potential buyer is. But just on the fundamentals, the company should be worth less. And just to circle back on the segment performance, on the studios, the studio performance, I think, really does underscore how hit-driven the movie business is. And David Zaslav talked about this morning on the conference call, but that's unpredictable revenue, and that's just the way the studio business has always been. When it comes to TV, you use the words, they can't be forgiven for this. I'm going to just tweak that language a little bit to say that in their defense, partially, the TV world is extremely challenged right now. Cord cutting is prevalent, as we know. That affects them on the distribution side. And content has gotten ever more expensive and competitive to get. And if you get any slight decrease in your content slate, it's going to reflect through in the audience, which of course then reflects through in ad revenue. So Warner Brothers is being impacted both by cord cutting, but also, as you said, with respect to content, they lost the NBA deal. And that was a big deal for them. And they got squeezed out by Amazon. And that's a lesson that Paramount knows very well, that the escalating cost of sports, primarily due to the entrance by the tech companies, Amazon, Google, Netflix, of course, Apple, is only going to continue. And to the extent that those marquee rights cost ever more, companies with the strongest balance sheets are going to be financially advantaged, and those with the weaker ones are going to get squeezed. And this has already now happened to Warner Brothers with the NBA. Makes it even more precarious as we go forward. And I just want to add quickly, just to bring this back to real numbers for a second. So a little bit of back of the envelope here, when we think about this company's deteriorating financial performance. In the second quarter of 2026, between Warner Brothers and Paramount, they paid about $766 million of interest. If you multiply that by 4, roughly, to annualize interest, that means that the combined companies would pay about $3.1 billion annually. As part of this deal, they're proposing to take on new debt of approximately $40 billion. I'm just rounding that off. $40 billion at the same comparable rate of interest as the existing debt would mean incremental interest on an annual basis of $2.8 billion. New interest of $2.8 billion per year, plus existing $3.1 billion of interest, means new total interest is $6 billion, going to be $6 billion for this company. It's likely to be even more than that because we are in a rising interest rate environment, as I mentioned last week. The issue there is that when you're piling $80 billion on a company with $6 billion a year of debt service, as a lender, you're looking for predictability in earnings and cash flow. What we just talked about with the studios and the volatility of the hits and how that translates into revenue and earnings makes that a higher risk proposition. Then you layer on top of that the declining trends in the TV business. And I would just say that, if I were the lender on this deal, that I would be looking at this with fresh eyes, with a fresh pair of eyes. I mean, what can this company really support given these fundamentals and given the unpredictability? I don't know exactly, but I'd certainly be taking a close look at it.
Yeah, me too. I don't know if I want to be paying that mortgage, Will.
Well, the last piece of this, and then we're going to move over to Disney. The last piece was in this whole swirling environment, David Ellison, who of course runs Paramount, published an op-ed this week in the New York Times. And of course, they're trying to make the case that there's not an antitrust issue here. And, why publishing a op-ed in the New York Times really matters at this point, given that it's all in the judge's hands, I'm not really sure. But in any event, there it was. And his point basically is that we're planning to produce more movies. We're going to create more, moviegoer and TV viewer content diversity, et cetera. We're going to create more jobs for writers, et cetera, et cetera, et cetera. We're going to increase our slate from something to, over 30 movies per year, et cetera. And, the question I think that's legitimate to ask is, when you consider the financial obligations and the declining performance of this company, how reliable are those predictions, right? If that movie studio underperforms significantly again, and the trend lines or the trend lines accelerate on the TV deterioration, are they really going to be producing more movies and hiring more writers and servicing that $6 billion of debt at the same time? I don't know, but I would, again, if I were a lender, be looking with a fresh pair of eyes at this. Yeah. And this for sure is what the judge is going to be looking at. Not that the judge is here to evaluate the wisdom, the financial wisdom of the deal. She's just going to be looking at the competitive side, which actually, as we've talked about before, is still, in our non-antitrust lawyer point of view, still a pretty decent argument for Paramount. Careful what you wish for, I suppose.
Exactly. But maybe we should move on to our second topic today.
Yeah, let's do it.
So Disney announced their results, which on the whole were pretty good. They, the company continues to do pretty well. I think it's fair to say that revenues were up pretty solidly. But I don't really want to talk about the revenues. If people want that, they can certainly go and check that out on the financial pages, but they were pretty decent. I really wanted to talk about the call with new CEO Josh D'Amaro. And it was pretty interesting, Will, because we talked in the past, I think, about how Disney is beginning to look at Disney Plus as a vehicle for the entire company. And as he talked, it became really clear to me that Disney Plus, the app and service, is moving to the very center of what Disney is. And there were several announcements here that I think really illustrate that move. So perhaps the first one that we should talk about is, I think it was announced just before the results, Disney has entered into an agreement with TikTok. And the TikTok agreement is pretty interesting because listeners will remember that there was a deal that Disney did with OpenAI for a tool set, drawing tool set and creativity tool set that fell through because OpenAI simply couldn't deliver the tools. And Disney's strategy there was they've launched this thing called Verts in the Disney Plus app on mobile. And this is for shorts. And their strategy there was to recruit people, Disney fans, Disney members, to create fan videos to populate Verts. So when this strategy fell through with OpenAI, they were sort of open. This agreement with TikTok seems to be their answer to that falling through. And so what are they doing here? Well, basically what they've done is they've signed a deal with TikTok, which will provide a bunch of assets based on Disney's IP that fans can use to create fan videos and fan content around. Now, they use a very interesting phrase in their PR for this, Will. They say it will bring an expansive collection of thoughtfully curated Disney-centric fan-created content from TikTok to Disney, but that these creators have to sign some sort of agreement to create the content. So it sounds like this content is going to be in some way bound to Disney, and that they have to sign an agreement before they can make the content. the content that is made under this agreement will be available both on TikTok and on Disney in Disneyverse. So this, on one level, this actually does what Disney wanted. It gets them that fan-created content which should draw in younger viewers. But they don't own, it looks like they don't own that content. At least it's not clear that they own that content, because that content will also be on TikTok. So in other words, this helps TikTok as much as it helps Disney Plus. So less control. It does get them what they were looking for, which is this for content, but they get it with a lot less control than they had before. I don't know. What did you think about this TikTok deal?
Well, first of all, I agree with everything you just said, as I understand it. And again, all I have, like you, access to is the press release on the deal. So there may be more going on here than meets the eye. But, I think there's value in this, for sure. I think there's value in this. The overarching strategy, trying to get fans more engaged with the content, give them some freedom to kind of do their own thing. That's all to the good. If I understand it correctly, I am not seeing any mention of AI in this TikTok deal. That was really the defining characteristic of the OpenAI Sora deal, was that they were going to empower creators with Sora, which of course has now been de-emphasized by OpenAI, but they were going to empower creators to access a set of assets from Disney that they could then manipulate or enhance with AI tools from OpenAI to really create something brand new, which I think was, with appropriate guardrails, would have been really exciting for Disney. This TikTok deal does not feel as exciting to me as the OpenAI deal felt, but maybe it's the first of additional deals to be announced. And certainly AI is very much in flux, and Disney may have just decided, let's do something, i.e. a TikTok deal right now, while we continue to figure out how we're going to play the AI stuff. What do you think?
Right, exactly. As I say, I think it delivers much less than their previous strategy. Of course, there's much less heavy lifting involved for them. It's really just a licensing deal of the content, and it'd be interesting to see. I'd love to take a look at the deal that creators have to opt into to get a hold of this content. It'd be very interesting to see what that says. It gets them part of the way there, but I'm not sure it gets them all the way there. The fact that it will live both on TikTok and on Disney means that the incentive for a young person who is on TikTok that wants to view the content to move to Disney is still pretty low, right? We know it's very difficult to get people off their preferred viewing platforms, and I don't think this will help very much in doing that. So
yeah, I agree. I'd just be interested in seeing some examples of what Disney has in mind that TikTok creators are going to do, and help us all understand how compelling and original are these things going to actually be, because I'm not getting a strong read on the compelling index from the press release, but maybe I'm missing something.
No. The second thing they're doing, which I think will help reposition Disney Plus, and I'll get to why I think that in a moment, because at first this doesn't sound like it's going to do that. That is that Disney is now exploring a free product. So they're looking at entering the FAST market. They see it accomplishing, they say, several goals. It's a way to expand reach, they say, to a customer segment that's very price sensitive. They obviously have a lot of content that I think they can repurpose and use that's sitting on the shelf that could be rotated in and out of a free service like this. And it will also undoubtedly drive people to subscribe. The problem for Disney is that this is a very, very competitive space. It's a space that continues to evolve. And it seems like even today that evolution is continuing and shifts are pretty large. So I want to point at here the fact that Fox is trying to buy, or is working through buying Roku. And the reason that matters here in this market is because Roku Channel is the top fast service in the country, followed closely by Tubi, which is owned by Fox. So Roku Channel in the last Nielsen Gauge report, 3.1% of TV viewing, Tubi 2.3%. So that would basically, if those come together inside of Fox, that gives them 5.4% share of TV viewing in the US just on their free fast offerings. So it would be actually quite hard, I think, for Disney to make an impression in this market unless they do what I think they should do, which is they do not launch a separate app. This is part of the Disney Plus app. Because if they do that, once everybody updates their Disney Plus app, they'll immediately have free content. There's reason for people to download the app who don't subscribe to Disney now to watch the free content, and then they get the opportunity to upsell them, and that, I think, that would get them quite quickly a decent foothold in the business. By the way, it might also bring some more interesting content to get the viewership inside of Disney, even of subscribers, up, because there clearly isn't enough content in there because people just are not spending enough time with the service. What do you think? Do you think they should launch this fast service?
I'm going to raise a yellow flag here on Disney pursuing a fast play. Disney content, by definition, is premium content. Associating the Disney brand with anything preceded by the word free feels like a slippery slope for them. Now, of course, Disney has a stable of non-Disney branded content, whether it's, ABC or Hulu or FX but they have a stable of other content. So I think if the fast service were to be populated and carefully delineated from the Disney brand, which could run counter to what you just described of including fast within the Disney Plus app, then maybe it works for me. But I think this is careful ground to tread on for Disney.
Yep, indeed.
It's one thing as an example, comparison, Versant just launched Fandango fast service. It's one thing for Fandango to have a fast service, no disrespect to the Fandango brand, but it's a different matter entirely for Disney to have a free service and what that means for the brand.
Right. So the other thing they're doing here is they are looking for ways to get it used more by people that are subscribing to it. They're doing two things. They mentioned two things in the call. The first thing they said is that they're going to become an aggregator of third-party services. Josh D'Amaro actually said, we do think that Disney Plus can be an aggregator of third-party services, that we can do this both through bundles and add-ons. And yeah, I think they can. We know Netflix, this is a business Netflix is beginning to step into as well with their agreement in France, which they've said that they're going to bring in elsewhere. It's pretty interesting, Will, because now we have another layer of aggregators emerging in the market. Before, the aggregator was really the platform, like the Roku OS or Apple TV OS or whatever. It was that sort of level of integration. And now it's one step up. It's actually in the apps, and those apps that have the greatest reach stand the chance of becoming most powerful. And as we've seen from our friends at Antenna, aggregation with big distribution can be very powerful in helping to sell SVOD services, as we've seen with Amazon Channels and the Prime Video app. So I think that's a pretty good idea there for them to do that. And they also say that they're going to be bringing some free sports content into the app. So you won't only be getting sports content if you've subscribed to ESPN Plus or ESPN Unlimited. There'll be some sports content inside the Disney Plus app, whether you subscribe to any of that or not. So, I think this really illustrates how central Disney Plus is becoming to Disney's overall strategy. Of course, they've talked about it also having relevance to people going on cruises and to people being in the parks and going to the parks. So it's very interesting. I just want to finish up with one more thing that he said, Josh D'Amaro said. He really talked about the fact that this is only possible. All of the things that they're planning on doing is only possible through a direct-to-consumer relationship inside a wholly controlled and branded environment. And it's all about this first-party data that they're going to get from it, Will. And it means creating a highly customized experience wherever a Disney customer is using this app. So I think it's a pretty interesting strategy and something actually very unique to Disney, that Disney is one of the few companies that can position its streaming platform this way.
I agree with all of the above. I guess I would just say that as Disney is reaching out to third-party services that would be integrated into Disney Plus, that trumpeting how important it is to Disney to have a first-party relationship with subscribers might spook some of the partners who are going to get subsumed within the Disney Plus app. So you can't really have your cake and eat it too in this world. So, we'll see how Josh tomorrow.
It's true enough, Will, but let's be real. Prime Video's getting away with this. They're getting all that first-party data.
No disrespect to Disney now, but Disney ain't no Amazon. So there's a hierarchy out there depending on what axis we're using.
So you think only the tech bros can pull this off?
Well, I mean, I'm not defining it by tech bro per se. I'm defining it more by who has the credit card relationship and who has the ongoing login relationship. Yep. And that's where, of course, Amazon has excelled, and Netflix, as you've pointed out, believing it has a big play here too. I hear you. Certainly YouTube has a big play. Disney, maybe, not sure.
Yeah. Well, I guess we'll wait and see. Anyway, very interesting relationship announcements there, and I'm looking forward to seeing the evolution of Disney Plus, because I can tell you right now, I don't spend a lot of time inside Disney Plus. I do spend time inside a Hulu. Be interesting to see if they can flip me so that I'm spending more time in there.
Well, I don't spend any time in Disney Plus. I would be even less of a candidate for them to be an aggregator for me. But there's absolutely no question Disney Plus has been a massive success story for Disney. Massive success. And
absolutely.
we have to give them huge props for execution. So I think that's all. Is that all we have on Disney?
That's all we have on Disney, I think, for today.
All right. Well, we'll continue with the next week if there are more updates on the Warner Brothers and Disney, and hopefully Larry Ellison, the lenders and the equity contributors are taking a moment to look at today's financials, as we are.
Yes.
All right, Colin, that's all. Thanks for chatting. Thanks, everybody, for listening in on this week's edition of Inside the Stream, and we will see you all again next week. Inside the Stream is a production of In-Screen Media and Video News. All rights reserved.